We've had a big week of earnings, notably Tesla reported after the market close on Wednesday, and in all honesty the results themselves were not the greatest. They actually missed, with in fact the automotive element of their top line down 8% from the same quarter last year. In terms of how poor the numbers were, well, earnings per share 73 cents versus 76 market expectation. Revenue as well coming in 25.7, the market wanted 27.6, and on top of that their bottom line also down, net income 71% from the same quarter last year. Now, it isn't looking the greatest if you are solely looking at the automotive element, because there are other attributes with this company that investors like, not to mention the robotaxi as well as robotics. However, if we do solely focus on this company, on the automotive element, we can see that a lot of hefty discounts were offered in 2024, and that for the time being and over the last few years, that has made up the bulk of the top line revenue. Having said that, the company is still up around 3% today, also up over 100% over the last year, and currently trades at the upper end of the 52-week range. Now, bear in mind, we are going to look at Uber as well, but this company, from the perspective of every single analyst, is considered to be a hold. But on the flip side, we do need to look at the future, and that is what Elon Musk is pointing to. In fact, he is saying in the short term, we are talking about June this year, robotaxis will go live. Now, skepticism, and no surprises, is incredibly high about whether or not this can be pulled off. But if we just take a look at what has been promised, but essentially he's saying the unsupervised model of the robotaxi service will go live in June, specifically in Austin, Texas. In fact, he has gone to say that he anticipates this to be in every single market by next year, and that 2025 could be the biggest year in Tesla history. Now, the article goes on to talk about why they say there is a very large amount of skepticism that goes along with these targets, because he has made a prediction of the imminent arrival of such a capability in what they say every single year for over 8 years, and most importantly, he has not delivered. But this 5-month prediction by June is one of his most short-term ones, and we will see and find out very soon how well this is, and if in fact if it can be executed. So what this means is that cars, or the Tesla cars in fact, will be able to pick up riders with nobody in the vehicle, and that is from June, as he said, by next year in every single market, and that it does not require any mapping, and that basically it can spread quickly, and many regions of the US are expected to have this in fact by the end of the year, not even by 2026. And then he goes to specifically say that next year it will be in almost every single market. However, this is limited by regulatory approval. Now, if we look at the other company that has been affected, it is Uber Technologies. Now, bear in mind, over the last year, this company is in essence flat, and unlike Tesla, it is trading towards the lower end of the 52-week range. But also, unlike Tesla, analysts do give this company a buy rating. In fact, Quant call this a strong buy. Both Seeking Alpha and Wall Street, in fact, do say this is definitely one to seriously consider, with Wall Street 4.47, not far away the 4.5 that would flip this company into another strong buy. Now, what's very interesting, we did hear from the CEO of Uber not too long ago, where he was discussing his doubts essentially on Tesla's robotaxi plans, and how ultimately he doesn't believe this is going to affect Uber. But that is definitely something you need to consider in your own investment thesis, whether or not you believe one will win over the other, or in fact they can go hand in hand. So one way in which this could hurt Uber, Elon Musk, as we said here, has spoken in length over the years about the hopes that this platform that they are looking to release could let their owners' vehicles work in a ride-sharing capacity, in essence doing the same thing that we do see from Uber right now, but there is no need for someone to be sat at the wheel, making it a lot more profitable, and as we said here, effectively making the money while driving themselves. Now, in terms of the doubts that the CEO does have over this, is that for one, he says peak ride-sharing times might be actually when the owners want to use their own Tesla, and therefore this essential concept does become redundant, as what it will mean is that people will look to Uber to get their taxi to take them from A to B. And another point that he does mention here is that he doesn't believe as a society we are yet ready or prepared for self-driving vehicles, and maybe there is a lack of trust whether you would go for a self-driving car, or in essence whether the price is a little bit more or a little bit less, you would prefer the comforts of knowing that ultimately an Uber driver will get you where you need to go, as they have historically done. Now, he does accept that logic would dictate that if robots are twice as good as a driver or even 3 times less likely for crashes, less likely for incidents, that is ultimately then good for society, but he just doesn't know whether society itself is ready to accept this and therefore ready to prepare, move away from Uber and in towards this Tesla ecosystem. And he also talks about the complete different business these two are. For example, whether you are buying a Tesla car with the software 20,000 or 50,000, he's saying your revenue basis would be very, very low. You would need to get a lot of transactions in. And there are also other issues that he does talk about this. In fact, he's saying that a lot of things can go wrong in a ride-sharing vehicle, people getting sick, wanting to pay cash, those losing their items in the rideshare, as well as many others. But again, this is something you could also associate with getting into an Uber. In terms of where the institutions are putting their money right now, though, 66% ownership of Tesla, and whilst they have been selling around 20 billion over the last year, in the same time frame, institutions have been buying nearly twice as much, but in the most recent quarter of Q4, we do see a little bit more selling than buying. When we then switch to Uber, there's a lot more ownership, sitting around 81%, and again, around 10 billion worth of sales. Institutions do sell this company, but very similar to Tesla, they have been buying more than twice as much. In fact, we actually noticed in Q4 something we haven't seen in quite a while. Institutions were continuing to buy quite a significant amount more, in fact more than 5 times of what they were selling. When we also look at the two companies in terms of how they've performed, you could argue here Tesla not the greatest in terms of when they have expectations. They have missed 75% of the last 4 quarters, 3 out of 4, but out of the next 4 they do anticipate every single one to be growth. And if you were to look at this company right now based on the earnings per share, the forward PE does look very costly at 133. Definitely a lot baked in. A lot of investors are expecting big things to come out, not just in the robotaxi, but also Optimus robot, as well as many other areas that really will justify this very expensive valuation. On the flip side, we have Uber, who have a 75% track record, 3 out of 4 beats, and out of the next few, there is a bit of inconsistency in expectations, but with their earnings per share, they do trade at a significantly lower valuation of around 28.6. Now, you could argue there is a lot more upside to Tesla if they do execute on those promised points, but it will come down to whether or not you do have faith. And we're also going to run into our valuation very shortly. And there's also another thing to consider, that is Waymo, which has also actually done very well in 2024. They have spread to many states over the last few years, and if we were to look at the number that they have in fact done, just look at this. This is very interesting to see. The global share riding market is expected to grow from around 123 billion last year to 480 billion. So that is a lot of growth. That will be interesting to see whether Waymo takes that, whether we have Uber in the mix as well as Tesla. But the one thing that Waymo has done very well is that it has completed a lot of trips. In fact, since 2016, they have completed more than 5 million autonomous trips, of which 4 million of them have been paid in 2024 alone. And that is a massive jump from what we have seen, 700,000. That is a 7 times increase from what they had noted in 2023. So very impressive. Again, things just to consider. And when Tesla did release this, and when Elon Musk was talking in the commentary as well, both Uber as well as Lyft were down around 3 to 4%, but we can already see the market has adjusted to that. They have digested the information and it has started to rebound. So again, question needs to be considered. Do we believe over the long run Uber will be pushed out? Will in fact this really harm their top line revenue? Which, when we take a look at it, it has been very inconsistent over the last few years. Yes, double digit, which is impressive. Some years a lot better than others. But again, the same can be said for Tesla. If we look at their growth, it has been very strong. But again, just the most recent year, it was up only 1%. So investors will be looking at Elon Musk to execute on his promises. And as we heard earlier, there is a lot of skepticism based on broken promises. Now, before we jump into the valuation of each one of these companies, we do want to let you know we have released our latest free weekly article. We drop one every single Monday morning where we talk about severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up, read straight away. where you'll be able to gain access to 46 undervalued stocks for the month of January, lots of information for each one, upside Wall Street themselves see over the next year, and tomorrow morning we are releasing our February copy. On top of that, you can grab a recently released copy of 43 stocks that Wall Street themselves believe have the most upside in the S&P right now, so click below, you can sign up and read straight away. So if we start off with Tesla stock, now we have talked about this, our intrinsic value is $244 based on the DCF model, significantly lower than their current price, but bear in mind we are going off their historical data. Sure, if they do bring out robotaxi Optimus very soon, then this will change what we see, but what we've got here is their free cash flow. Now the growth rate we've gone for is 35%, average is skewed as they have been negative quite a number of years, but we also have a low, medium and high rate, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Tesla or any others. But based on 35% with the discount rate, we do get that intrinsic value, which comes to downside of 39%. Now, just for transparency, we will show you at 30%, it comes to 179, which is downside of 55, and at 40%, we ultimately get here still downside $331, that is 17% negative. Now, what we typically like to do on the channel is take the medium rate, where we do apply a margin of safety, but this shows us right now, we see this based on historical data, this company trading at a massive premium. Now, Wall Street themselves see this at $335 by the end of 2025, which means downside of 16%. But what we can highlight to you here is that isn't too far off the 40% growth rate. So Wall Street themselves see around 40% year-on-year increases to their free cash flow. It remains to be seen whether we'll get that or not. And for those that are interested, based on the 244, it would be a buy at 220 with 10% MOS, and at the 20% margin of safety, 195. But as we said, right now, based on what we can see, it is looking like it is trading at a premium, and it does trade for a very high forward PE. On the flip side, if we do look at Uber, we do get an intrinsic value of $93. As you can in fact see, we have gone from a low growth rate of 12%, well below the average, and we have a 10, 12, 14. At the 12, we get $93, which we have used. That equates to 39% upside. But as for those who want to see the margin of safety, as we keep going, we can in fact see at today's rate, you are getting a near 30% MOS. With Wall Street themselves, we saw nearly a strong buy rating, Quant with the strong buy, Seeking Alpha with the buy. They see this at $91 at the end of the year. 36% upside, and they don't believe that this Tesla news that has come out is really going to upset the Uber business model. As always though, do give us your thoughts. 30% MOS, 36%, some people will like that, others in fact would be happy to pay for a premium for Tesla. They do believe that they will execute on all of their promises, and that in turn over the next few years we will see a lot of their numbers, like the revenue, the free cash flow, like their margins, really skyrocket. Don't forget, as always, sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we do cover our weekly buys and sells. We have recently bought some stock as well as sold, and have a great day. We'll see you all on the next one.